All right, what's going on, everybody? Welcome back to the MIE Trading Podcast, the podcast where I share my knowledge and experience on trading psychology, strategy, risk management, and everything else you need to know to improve your trading each and every week. My name is Brendan Murphy, and today I'm going to be covering all of the questions you might have about a trading journal. And on top of that, you're also going to get a free spreadsheet that you can use for free to track all of your trades and get all of the key data you need to improve your performance. And so very quickly, before we get into the topic of the video, please remember to subscribe if you're new here. That way you never miss out on the latest ways that you can improve your trading performance. In this video, I'm going to be covering number 1, what is a trading journal? Number 2, why do we even need one? Number 3, what should we track in our trading journal? What things should we be putting in there? Number 4, how do we use the stuff that we're tracking to improve our performance? And then number 5, obviously the free spreadsheet. And number 6, I'll quickly go over my trading performance myself. So let's get right into the first question, which is, what is a trading journal? And to put it simply, a trading journal is simply a tool that you use to track the important parts of the trades that you make. However, it's also much more than that. It's a tool that we can use to increase our performance as a trader. Now, let me ask you a question. As a day trader, you generally want to be as profitable as you can, right? The answer is obviously yes. And in light of your goal to be as profitable as possible, you would want to do whatever it takes to improve your profit. You want to get access to all of the tools that you need to improve your results. And so a trading journal is probably the most powerful tool that you have access to as a trader that you can use to improve your performance. And it's free. There are tons of other things that you can pay for that do increase your performance, but nothing actually compares to the raw data and relationships you get access to using a trade journal. And so that is why it is the most important thing that you can have as a tool for increasing your performance. And we can get really detailed with a trading journal too. Like, for example, you can track very specific things such as your emotions during every trade. You could track right down to the hour of the day that you trade best. You could track what instrument you perform best on. There's no limit to the number of ways that you can track your performance and improve it using your journal. You're literally only limited by your creativity. And so that covers question 1, what is a trading journal? And so now that you know what a trading journal is, let's answer question number 2, which is, why do we even need one? And there are 3 reasons that we need to keep a trading journal. Number 1 is that it allows us to collect data and track that data over a length of time. And you can track literally any data you want. As I just mentioned, you can get as detailed as you want, and you're only limited by your creativity. So for example, you could track the instrument that you're trading. You could track the date and time that you enter. You could track whether you win or lose. You can track how long you're in the trade for. You can track whether the RSI was above a certain threshold when you entered the trade. There's literally no limits to it. The second reason you need to keep a trading journal is because it allows you to identify and visualize relationships within the data that you're tracking. For example, you might be able to see relationships such as, if I trade after 3 p.m., then I am 15% more profitable. Another example could be, if I trade when I'm feeling extremely greedy and I overtrade, then my performance is 20% worse. Another example could be, if I trade in the morning as soon as I've woken up without following my pre-trade routine, then again, my performance is worse. And you can look for relationships with any 2 or more variables that you track, and you can say, all right, now I know what the relationship is. And then the third reason is that it allows us to predict how certain changes in our trading approach will impact our performance. So basically what that means is you take the relationships that we identified in step 2, and we look at how, if we change our approach based on these relationships, how that's going to impact our performance. If in step 2, we identified that we trade worse after 3 p.m., for example, we can now say, okay, let's reduce our position size after 3 p.m. or eliminate it entirely. And theoretically, that's going to give us a 15% boost in performance. And so you adjust your trading approach like that, and then you are now more profitable. You win more often, you win bigger, you lose less. That's the 3 reasons why we need to keep a trading journal. Now, let's move on to question number 3, which is, what should we track in our trading journal? Now, I've got 2 categories for this one, and that is the bare minimum that you need to track And then there's the extra / more advanced things that you might want to track if you really want to get fine-tuned and you consider yourself, you know all the basics, you want to take it a step further. So let's first cover the bare minimum. The first thing you want to track in your journal is the instrument you're trading. Now, the instrument just means, what is it you're trading? Are you trading gold? Are you trading the foreign exchange market? For example, are you trading the US dollar compared to the Japanese yen? Are you trading the euro to the Great British pound? Are you trading Tesla? Are you trading Nvidia stock? Are you trading CFDs on the S&P 500 index? Whatever it is you're trading, this is your instrument. And so whenever you make a trade, for every single trade, by the way, all of these things, you want to track them for every single trade. You will track, number one, the instrument while you're trading. Number two is you want to track the date and time of your entry. So when you make the trade, you want to say, okay, today is the 29th of May and it is 9 a.m. I made my entry. Then you want to track whether you went long or short. So did I go long? Did I buy the stock? Or did I go short? Or whatever instrument it is. I'm just saying stock. And then number four, you want to keep track of your exit trigger. So that just means did it hit your take profit? Did it hit your stop loss? Or did you exit for some other reason? For example, price shot up quickly and then you wanted to quickly take the profit, even though it wasn't at your take profit yet. Number five, you want to track the exit date and time. So again, once you close the trade for whatever reason, you want to say, all right, I closed it on May the 30th at 12 p.m. And so that tells you how long you were in the trade for. Then you want to track whether that trade won or lost. And then lastly, you want to track how much profit or how much loss you had from that trade. Whether that was $100, whether that was $200, whether that was negative $50, which would be a loss, whatever it is, keep track of that as well. And so they are basically the bare minimum, very most important things you should be tracking for every single trade. Now, if we want to move on to the more advanced things we could trade, number one is we could also track our emotions. If we enter a trade, are we feeling fear of missing out? Are we feeling greedy? Are we feeling doubtful? Are we revenge trading because we just came off a string of losses? The reason this is more of an advanced thing is because when you're brand new to trading, you might not have the ability to recognize these emotions in your trading. And you might, let's say, trick yourself into saying, I'm trading perfectly rationally and I'm not feeling any emotional bias, when you might actually be. Whereas someone with a lot more experience is better able to be in tune with their emotions and say, yeah, I am trading emotionally. The second more advanced thing we can track is our reason for entry. So we make the trade and then under reason for entry, we might write stock raised 2%, RSI is above 80, interest rates have risen whatever percent. So therefore I'm going short for the pullback. And then you also want to track your reason to avoid entry. You don't want to have a confirmation bias and you don't want to just look for the things that support where you want to trade. So for example, if you have those things and you want to go short, look for reasons to suggest the stock might continue to go up. Has there just been an earnings release? Has there just been a news announcement and the stock is expected to rise 6%, where now going short seems like a bad idea? Look for reasons to go in and also reasons to avoid, so that way you're looking at both sides of the argument and you have a more rational overview of what the market's actually doing, rather than just looking for things that confirm your bias. The third more advanced thing you can track would be your hindsight thoughts. So after you close the trade, you might be able to look back and say, okay, this is what I didn't see at the time, which could have suggested this was a bad trade. Maybe I overlooked that when volume spikes a certain amount, we then tend to have a reversal in price. I didn't look at that, and so this was a bad entry. And so you track these hindsight thoughts, so then you can say in future, I'm going to look for this thing and I'm going to avoid those bad trades. The fourth thing is you might want to track your instrument price. This one isn't that important, but it is just extra data that we can use, and we can say, if the instrument price is over or under a certain amount, do I tend to perform better or perform worse? The fifth thing we can track is the position size. What was our position size of this trade? Did we go in bigger for whatever reason? Did we go in smaller to reduce risk for whatever reason? Did we maybe gamble a little bit? Did we have too big position size when the data suggested that that was a bad idea? And so those are the 5 more advanced things that you can track in your trading journal to get really fine-grained details and really hone in on the very specifics about taking your trading to the next level. And so now that we've answered the things that we should be tracking in our trading journal, both the bare minimum and the more advanced stuff, let's move on to the next question, which is how do we actually use this data? How do we use the things we track to improve our performance and become a more profitable trader? Because that's the whole reason we're keeping a trading journal, right? We want to improve our result. And now for the sake of keeping this video shorter than 2 hours long, I'm only going to go over the bare minimum things and how we can use the bare minimums to improve our results. If you're an advanced trader and you're tracking the more advanced things that I've just mentioned, you already know how to use these to improve your performance. So let's go over the bare minimums. So number 1 is our instrument. And we can see if we perform better trading Tesla versus Nvidia versus the S&P 500 versus Forex, whatever you're trading, you can compare. You can say, all right, do I perform better on Nvidia or do I perform better on Tesla? Number 2 is date and time. You can see if you trade better on Mondays versus Wednesdays, or Tuesday or Thursday or Friday. And you can see if you trade better at 3 p.m. versus 9 a.m. or 12 p.m. or 1 p.m. or 5 p.m., whatever the time is. Number 3, long or short. You can compare if you're more profitable when you take shorts or when you take longs. Do you generally trade better going short? Do you make more money going long, but you also make bigger losses? Like, you can get really, again, fine-tuned with this stuff. Number 4 is exit trigger. You can see if you do better when you set the trade and you wait for it to hit your take profit or your stop loss. Or you can see if a more complicated exit criteria, such as if the moving average turns around and the RSI is above a certain number, then exit. You can compare the 2 approaches and see which one makes more money. And then with the exit date and time, you can see if you do better, let's say scalping or like really fast-paced day trading, where you're holding for minutes or hours, and you can compare that to holding trades for hours or 6 hours, 12 hours, or even a couple days. You can compare which is better. If I trade more frequently and quicker, do I make more money? Or if I trade slower and I hold on to positions longer, do I make more money? You can track whether you win or lose, and so you can see if your win rate is higher and how your win rate is affected by all of the above things we just mentioned. And then with profit and loss, you can see how your profit and loss is affected by all of the above things we just mentioned again. And so to put all of these together and give you an example of how you use that to improve your performance, you can say, all right, let's analyze this data. Now, I perform the very best trading Tesla on Mondays at 2 p.m. when I let the trade close by stop loss or take profit and I don't close early, and I hold the trade for less than 8 hours. That tends to result in the highest win percentage and the highest profits for me. Now, this is just an example. And then you can also say, this is the worst case scenario for me. I perform the worst and I consistently lose when I trade, let's say, Costco on Wednesdays at 6 a.m. And when I go short, I tend to lose more. When I close too early, I tend to lose even more again. If I hold the trade for a really long time, I then tend to lose, my win percentage is lower, and my profit and loss is worse. And so what you can do with those 2 examples is then you can adjust your approach. Okay, I'm gonna trade less on Costco, or I'm gonna avoid it entirely, and I'm gonna trade more on Tesla at that specific day and time when I perform best. And so now you've got a much more refined approach that's much more profitable, because based on your data, you're now doing more of what works and less of what doesn't work. And then as you keep trading using this refined approach, you keep tracking the stuff in your journal, and now you have a new layer of results, let's say. So now you can get even more fine-tuned. Okay, now looking at this very good part of when I trade Tesla, again, now what's the worst and what's the best? And you can adjust your approach again to improve your results even further. Repeat, 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 and your performance just continues to get better and better and better all the time. It's like an iterative approach. And so that answers all of the questions that we had for this video. By now you should understand what a trading journal is, why you need one, what you need to track, and how to use it to improve your performance. Now, in the link below, it's the first link in the description, you can download a free Excel spreadsheet that you can use to track every one of your trades. This is the spreadsheet that I use to track my trades, my performance, and I do this very often to, again, get that data and improve my own trading. This is also the spreadsheet that I use with my clients. You can click the link in the description or go to mie.trade/journal to download your free trading spreadsheet now. Now, quickly, before we end the video, as always, I like to do my weekly trade recap just to show how my own personal trading is going. This week, I had 12 trades. I had a 50% win rate with a net profit of 3.26%, which gave me an expectancy of 0.27% per trade. So pretty good week for me, especially the way the market's been lately. Not so good, but I'm still profiting, so that's awesome. So yep, that's everything for the video. Please remember to like the video if you liked it. Please remember to hit that subscribe button if you want to stay notified on the latest ways to improve your trading. Please leave a comment on what kind of things you like to track in your trading journal, because I'd like to see what you're doing. If you have a friend that might find the video valuable, please share it with them. And if you want to take your day trading a step further, get access to custom-made trading strategies specifically for you that are updated every single week, and get access to the most detailed analytics platform that you can use to improve your trades, as well as ongoing mentorship and free access to all of my courses, which is over $1,000 all for free. On top of that, you can go to mie.trade/get started to book a free call now. As always, thank you very much for watching. Hope you found the video valuable, and I'll see you again next week for the next episode. Bye-bye.